Good evening, all. Ira Epstein with your financial market wrap-up, and this wrap-up is for Tuesday, and here we are on the 13th of December, 2022, 6:36 p.m. Central Time. Let's go through what happened. Leading into today, last night, you didn't see me. But what I was telling traders, and by the way, the reason you didn't see me, I didn't put out the updates. It is that Christmas period for me. But beginning with that, I don't like going through major reports. And the major reports I don't like going through was this CPI. I had warned traders that I think that you stay away from this report, as I would recommend you stay away tomorrow from the Fed announcement at 1 o'clock and then the 1:30 press conference. Tomorrow you're going to get the Fed announcement, which will include the new dot plot. People will be poring over that, and they'll be listening to the Fed chair as to what he's now going to say about they're winning on the CPI number. It's dropping a bit. It's not collapsing. It's dropping a bit nicely, but not galloping lower. And what he's going to do about labor staying as strong as it is. He'll give us the answers. But do you think you can dodge that bullet in time? Example, just an example. If you were watching this morning, the Dow, the market was up going into the report, 100, 200 points. Report comes out, before you knew it, you're up 800 points. I swear, if you left the room for a short while and came back, all of a sudden you were up an hour later, 200 points, 300, and all of a sudden you're going negative on the day, negative. Then you're coming back. What's going on? You can't beat the algorithm traders when these reports come out. And they're hitting and running. Their orders are going. You can't type as fast as their order makes it, comes back, and they're doing a new trade as the computer. Can't be done. Why? They got the higher speed lines that you have. Yes, the exchanges have higher speed lines for a lot of these people. It's all done a different way, and you're trying to compete in that arena. You have to have either resting orders, or why do it? Because as fast as you're up or down, you're the other way. I've learned over the years to walk away from that environment. Now, it's a 2-day event where I don't want traders to do very much. That's okay. 365 days a year and 50 days, whatever. We got plenty of trading. Do I have to trade the financial markets right in front of that? No. There's other markets you can trade. You can go to grains, you can go to the soft commodities. There's plenty of areas to go, but I teach you stay away. And I'm going to stay with that through tomorrow. And then I think you can pick up the pieces. So what happened is headline and core CPI both fell by a bit more than was looked for. So if you were looking for a 2/10 increase, you got a 1/10. This is reality. So on one hand, I could say, oh, you only got 50% as much as you thought. And the other, I could argue, it's only a 1/10. What are you getting all excited about here? And that's going to be part of what this argument is down the road. But what people do is they'll say, hey, we were up here, we're now ratcheting down, and this is true. And we're now got 3 periods in a row where we're starting to see the ratcheting. That's a trend. I agree. No disagreement at all from me. So I think that we have a peak in CPI and core CPI, that in order to keep them on the right track, the Fed cannot reverse course on interest rates. They can at some point stop going up, but they can't reverse because you'll start the process over and you're nowhere near where they want to be as a goal. Let's assume that it's 2 or 3%. They're nowhere near that. They're minimum double that. Second, the Fed still hasn't succeeded in its labor part of the market. And if they can't beat the labor down, they can't keep CPI down. Logic. If after the holidays, people come back, spring, new employment, everybody gets more and more jobs. That's not what the Fed wants to see. They want to see some pain in the economy. The pain being the people aren't going to be able to demand higher wages, number one. Number two, too many people working. What happens then? More money in the system. They're getting paid every week. There's an M1, M2, and M3 amount of money that goes through an economy. And the velocity of the money, people get the money. Some people save nothing. They get a paycheck, they go out and spend it within 48 hours, right? We all know people like that. that will keep demand for goods too high. So the Fed's got to do two parts. It's got to, number one, find a way to get the cost of these goods and the demand for them down at the same time. It also demand function, all of that. Then you have to keep it down by not having the labor demand so strong it overwhelms the good you've done. They're not through, folks. I already heard today where people go, tomorrow's a fait accompli of 50 basis points. I'm in that camp now. Remember, I had an open door, 75 if these reports came out strong. They came out weak. Not falling apart, just weak. Number two, I already hearing the calls for 25 basis point hike in February and ended at that point. I don't think that's going to happen. Number one, why? Not because I think. Come February, we will have seen the December number and the January number. If they're super weak and employment is falling, those people could be right. If they aren't, those people have nothing to stand on. Now, where the Fed stops is going to be the important thing. You're going to hear now we don't have to go to 5.5 to 5.75% because inflation's falling more. And as long as it falls more, maybe the 5% zone is the zone. As long as the numbers say that, that's fine. But you need to get the terminal rate over inflation and keep it there so inflation keeps falling. And in that process, so that hiring gets impaired as well. Does that mean that in the stock market, as an example, maybe earnings are going to be a bit too high? Maybe these look too rosy for next year. I don't know, but that's going to be an argument that we hear a lot about. Now, today was the day of opportunity after the fact. There are people that always go into these reports. If you're going to get a spike to the upside, I'm going to ask you a question. What number should you be looking for? Or what numbers should you look for to be potential resistance? Well, over the market, if you have a key moving average, 100 or 200-day average, I would say that's a good spot. The next thing's your Bollinger Band, because only 5% of the time do you stay over that number. And generally, the first time you hit those numbers, they back off. That's the generality. So we look at a market. This is today. The market spikes up. The pattern, higher lows, higher highs. What did the market look like coming in? So let's go back just a little bit here and get a picture of this market. Coming in, you had lower highs, lower lows. If you take out this number, the market then is back into the potential of an uptrend, which it did. So here's the market, and of course you're there, and I'm watching traders jump right off the bat. And I'm watching the people on the news, the commentators are going, I see the people buying. And one guy said it right, Kramer. He said, this is suicide if you're buying this rally at this number. And go back this morning to CNBC and see his comment. He was right on it. I was jumping between Fox and CNBC back and forth, listening to the comments as to what they were saying. The difference I view between the stations is CNBC focuses very much on companies, whereas Bloomberg focuses on the markets. And I think there's a big difference there as to how you approach them. And I think they're equally as important. It depends macro, micro. That's how I view it. All right. So as I look at what that went on and look where you're at, let me bring you up to date now, right now here. Let's look at moving averages. Well, lo and behold, and I'm going to come back again with your permission. Here's the market coming into today. Stopped right at the resistance, the 18-day average, and you're waiting. Ira saying, I won't go in that train track. I don't know what to do. First main resistance should be the 200-day average. It stopped the markets before in that zone. Market takes, let's get up here. Let's give you that day. And here we go. We're going to get it. Okay. Where's the Bollinger Band, though? I didn't bring that on, did I? Oh, I think maybe we should. Oh, so now I'm going to back off again. I'm not going to do this for every chart, obviously. And you and I take a look. Here's the market coming in. I'm looking for resistance here and resistance here. I don't think this market on the first challenge of the Bollinger Band to get up there from this point to 4122, 100 points higher, is going to be able to hold it on that S&P. That would be my thinking on it. And I would be telling traders, hey, if you are long, and as a trader, I wasn't saying, but you own things in the stock market, and that's why I was so busy in my spider one. It's telling people, you have your orders in, you want to do some liquidation today. Probably a good move, give you buying power, maybe for the Santa Claus rally if it does come about. Here's the market, here's where you're at, and here's your momentum. You're not embedded, you hit the upper Bollinger Band. That's not a bad day. Take a look at the NASDAQ, the combination of the 100 and that. First time you hit it was today. Am I wrong? You tell me. Watch this. You had paused yesterday. Now you're waiting. Maybe you get there. I don't know that you're going to get there. But if you do, here's what I do know. Everything I teach in my course says this is where you're going to have orders and you want to come out if you're long. The trend is up. The market is now bullish. So the buyers are waiting at 11,863, stops under that low. That's what I think is now going on. In the Dow, what do you think I think they got out? Take a look at that Bollinger Band, my friends. Let's take a look at the Russell. You just missed it. Did I not say coming in that the Russell, and I said this over the weekend, and I think I said it on Friday too, that the weakest has been the ugly chart of the Russell. And I realize everybody's saying you want to own these small caps, and I'm not understanding why. The chart pattern isn't good. And it's the only one of the indices so far that didn't even get to the Bollinger Band. When we come to the VIX, what number do you think, if you get up to it, you want to come out? What number do I think the pros, after the fact, might have today decided to write some calls, hoping to get back to the 18-day average? I think it all happened like that for the pros. Just like that. Classic what I teach. Bollinger Band, 100-day average, just missed the 200 and falls right back to the 18-day average. They already covered them. That's what I think they did. So we get to the bonds. Off the report, you hit a Bollinger Band. Goodbye. First challenge, goodbye. You're not embedded. Goodbye. 10-year note, same darn thing. You're not embedded. You're up there again. It's resistance. I am not telling you to go into this report. I didn't have positions, but I can tell you what should be happening at these key numbers. It's right there. And on the downside in the dollar, come on. It's the same identical thing, which means in the euro, you want to be bailing up there too. Now, you're looking to see, do you embed? So let's see. In the eurocurrency, for the Tuesday action, both numbers were over 80. For the Monday action, both over 80. You think they were the day before? Friday? That means they're embedded. 3 days in a row. So now you're set that if the market drops hard, there's a key moving average that I think that the traders tomorrow will be nibbling on. Do I want to go into the Fed report? I'm going to again repeat myself. I don't do that dance. You can do it. I won't do it. I won't tell my traders to do it. I back away. It's too big a deal. Do you know what the Fed chair is going to say? Do you know how the market's going to react to it? Do you know that he won't say something that'll trip the market up? I don't know. It's a big day. We're not going to hear from him. You know, we'll hear him on the road speaking, but this is his speech until the next FOMC meeting, right? And this is his guidance. What does he see? How does he come out with this? And how does he handle the labor argument? I'll wait and see it. British pound up to the upper Bollinger Band. Now this week you have the Bank of England coming out. We're tomorrow, and I think it's Thursday is the Bank of England. It's Thursday or Friday, and the same with the European Central Bank. I think the pro money's doing a song and dance and walking away. As I told you, I think that you've got something of a trade bottom in Bitcoin, Ethereum. I see it in the market. The biggest damage is done. That doesn't mean they've turned into buys, but they're not sells. That's very important. They've arrested SBF. He's not going to get bail. That's really good news. And the CFTC, as a minimum, is going all after this man. he's got problems. How it generally works, because I saw this happen in the 70s and 80s in the commodity markets. When they go after, they get teams of attorneys and they financially break who they're going after. Then at the end of the day, if there's anything left of the person, they can do some jail time with it. They're relentless. And I'm talking the government. Relentless. And then you got the SEC, and I don't even know what civil charges are behind all this. But this young man has got a problem. Brent versus WTI crude all the way down here, giving you a bounce in the market. In the marketplace, you lost the embedded reading. The odds favor you're going to go back to the 18-day average of closes at the 82.71 level. WTI, same thing, you're going there. In the heating oil market, you're basically there. I had a terrible trade in January, heating oil. I shouldn't have stepped in it, I guess, all right? But that's me. I will tell you if I have winners and losers, okay? I made a bad trade recommendation in it. I'll stand by my calls this year. If I could repeat this year what I did last year, I'd be very happy. Overall, it's a pretty good year. And the biggest trade of the year I ever had was this year on one contract. But I gave back chunk. All right. And I had one of my clients rightly say, Ira, do I think it's going to go up to the 18-day average? Well, that's what I teach. When you lose the embedded reading, you often make a run. The word is a run for it. You've made your run. I don't know if you'll hit it or not. You don't have to go higher in this market. You've taken out a group of shorts, but you haven't begun a bull trend. Does that make sense to you? Nat gas, same thing. You haven't even cleared these old highs. So you put this together, you come up with game plans, and that's the name of the game. But what's the one thing you saw? Time and time again, that first challenge of that upper Bollinger Band, it could have been the lower one. I'm telling you, I think the smart thing to do is you take money off the table. You never let it hit it on the first challenge and don't do something the way I teach trading. You can do whatever you want. You want to learn my method? You want to be able to do it, be it stocks, ETFs, and the other? You want to try it and prove it to yourself if this makes sense before you put $1 in it? Take my course. We give you the charting software, everything you need to do it, study it, learn it. It's just a series of videos. You're going to master the course in 3 days. You're going to be applying it for 2 to 3 weeks, and all of a sudden it's going to stick with you. That's what I predict will happen. Take a look at this. Welcome. I'm Ira Epstein, and I'm here to talk about my enhanced Bollinger Band course. Now, many of you have taken my regular charting course, and if not, you might think you know something about Bollinger Bands. As you know, Bollinger Bands are an algorithm designed to keep the market trading within it 95% of the time, and on a chart, it will offer on the top part resistance, on the bottom support, and the idea is the market will travel within them. We know that sometimes it latches onto that band, goes up or goes down. Well, how do you play with that? Can you pyramid the positions off that type of thinking? Well, I've applied all 3 of these into 13 different videos that teach you my concept of it. And from that concept, you're able to work with weekly charts and or daily charts. The 13 videos, each about 7 minutes long. The idea here is not to put you in school forever, but to teach. Now, if you haven't tried my complete futures research, I throw that in as well. Whether you've tried this or not, I think it's worth taking a look at. I think you're going to learn something from there. That research, by the way, covers twice daily market updates for you and access to what I call window envelope numbers, which I think are very important when looking at these Bollinger Bands. The next part is a trial to our charting software so you can make your charts look the same way that mine do. It's that simple. Where do you go with it and how do you get all this? It's simple. You go to our website, www.iraepstein.com. If you go to the word education, everything you need is answered there. You can also call my staff. They'll be happy to help you get set up. I'm Ira Epstein on the road to your education.